Welcome to the deep dive. We're here to cut through the noise and get you informed fast.
Indeed.
If you've been keeping an eye on the markets, especially the digital asset world lately, you've definitely felt it.
Oh, absolutely. Some serious tremors.
Yeah, a sudden, pretty dramatic shakeup. Just yesterday, this wave of intense volatility just swept through, wiped out an astonishing amount of value in a single day.
It really was something.
So today our mission is clear. We're doing a deep dive to unpack the specific, maybe seemingly distant triggers behind this downturn.
Right.
We want to understand its immediate and, let's be honest, often brutal impact. And most importantly, explore what these events really mean for you, the informed learner, navigating this, well, complex global financial landscape.
And it's absolutely crucial to grasp this. In today's hyper-connected world, events that seem separate, global things, they can, and increasingly do, create these powerful ripple effects across the entire financial ecosystem.
Right across everything.
Exactly. Including sectors you might not immediately connect, like, say, traditional trade policy and cutting-edge digital assets.
Okay. So where are we getting our info for this?
Our insights today, they're primarily drawn from a detailed market update article. It was published just yesterday, August 1st, 2025.
Okay, very current then.
Very. It meticulously lays out the precise sequence of events, the things that sent shockwaves across the global financial system. It offers a really clear lens into this dramatic day.
Absolutely. And the speed, the sheer scale of this market shift, it wasn't just surprising, it was a stark reminder.
Yeah.
A reminder of how quickly these macroeconomic winds can just change direction. So, okay, let's unpack this. Let's pinpoint the exact moment that first domino fell.
Where did it start?
We need to rewind just a bit to August 1st, 2025. Now, this wasn't just another date on the calendar.
It was a significant.
It marked the deadline for U.S. President Donald Trump's latest and, well, pretty aggressive round of tariff implementations against numerous nations.
Right. This wasn't minor adjustments.
No. This was a specific pre-announced date for new global policy adjustments. Poised to shake up traditional trade routes, sure, but I think few anticipated the almost immediate fallout in areas far beyond, physical goods.
And what's truly fascinating here is that almost immediate direct link between these, like you said, traditional policy adjustments and the digital asset market.
Yeah, how did that happen?
Well, the president's executive order, it came with some very specific sweeping stipulations. First, he declared a new, across-the-board 10% tariff on goods imported from every country globally.
Wow, every country?
Almost. The only exceptions were 92 nations listed in an annex. And maybe surprisingly, they were instead subjected to even higher rates.
So no one was really spared.
Pretty much. It wasn't targeted, it was broad, almost indiscriminate. And beyond that, tariffs on Canadian goods specifically saw a significant jump.
How much?
They escalated from 25% to a sharp 35%.
Oh.
And the order didn't stop there. He also imposed what he termed reciprocal tariffs on a distinct list of other countries. Let's see, Vietnam, Switzerland, South Africa, Taiwan, Cambodia, Thailand, and Malaysia.
So a real mix there, too.
Real mix. And the president himself was quoted in the order, stating quite pointedly, "I have determined that it is necessary and appropriate to deal with a national emergency declared in Executive Order 14257 by imposing additional ad valorem duties on goods of certain trading partners."
That national emergency language, that adds a certain weight, doesn't it?
It absolutely does. It adds another layer of urgency and, frankly, unpredictability to the policy.
Okay, wow. So we're talking traditional macroeconomic policy tariffs on physical goods. Yet, like you said, it almost instantly translated into such a dramatic reaction in the digital asset space. How does that connection happen so fast? How does it bypass what some might think are the usual buffers of traditional finance and just hit crypto with such force? Is this just like a new pattern? Or are there deeper mechanisms at play we should know about?
That's really where the insight lies, I think.
Yeah.
What's fascinating here is how quickly the broader financial market interpreted these policy changes.
Okay.
And crucially, how that interpretation spilled directly into digital assets. Economic experts globally, they immediately rushed to offer insights. And one observation that really stood out was from the Kobisi letter. They're a widely respected financial commentary.
Right, I know them.
They noted that, quote, "The market says the trade war has lost all credibility."
Lost all credibility. What does that mean in practical terms?
Well, it's not just an abstract statement. It implies this pervasive perception of highly unpredictable, maybe inconsistent, perhaps even arbitrary policy decisions coming from a major global power.
Okay, so uncertainty.
Exactly. And when the market perceives such profound unpredictability in global economic policy, it creates immense uncertainty. And uncertainty, as we know, is often the most potent catalyst for a flight from risk assets.
Makes sense.
Digital assets, despite their innovative nature, their touted independence, they're still very much part of this interconnected global financial ecosystem.
Right. They don't exist in a vacuum.
Not at all. They react directly to this overarching market sentiment, even if the specific tariffs are on, say, steel or textiles. The ripple effect, and this is key, amplified by algorithmic trading and the global nature of crypto liquidity, is almost instantaneous.
Wow.
Think of it like a highly sensitive barometer for global economic confidence. Any sudden shock to that confidence, especially from a policy source that market participants struggle to model or predict, it just sends tremors through every asset class that thrives on stability and clear outlooks.
So everyone just runs for cover, basically.
Pretty much. This kind of widespread uncertainty leads investors, both institutional and retail, to de-risk across their entire portfolio. And crypto, being highly volatile and speculative, it often bears the brunt of that de-risking in a big way.
Here's where it gets really interesting then. Because that ripple effect wasn't just, theoretical, it was felt directly in your portfolio, in the portfolios of thousands of others.
Very real consequences.
The immediate quantitative impact on the digital asset market was truly staggering. We saw the total market capitalization dump by an astonishing $150 billion.
$150 billion.
In a single day. I mean, think about that number. $150 billion. Gone. Just like that.
It's hard to even conceptualize.
Right. That's more than the entire GDP of some small countries just erased in hours.
And Bitcoin, the king of the market, the bellwether, it saw a sharp decline.
How bad was it for Bitcoin?
It dropped by several grand, as the article put it, to a multi-week low of under $114,500.
Ouch. And hadn't it just recovered a bit?
That's the context that makes it even sharper. Bitcoin had actually recovered to almost $119,000 just the day before. That was after the Federal Reserve's decision to maintain interest rates.
Right, that provided a little calm.
A brief moment of calm, exactly. A sigh of relief across markets. But then, boom, this tariff news hits like a shockwave.
Yeah.
And it dumped by more than $4,000.
Wow.
And even after recovering some ground later in the day, it was still more than 3% down on the 24-hour cycle.
Yeah.
So this wasn't just a slight dip. It was a violent downward correction.
Yep.
Caught many off guard.
And while Bitcoin certainly took a hit, the situation for altcoins was, well, as often happens in these scenarios.
Even tougher.
Even tougher. ETH and XRP both experienced a sharp 6% drop, which, for assets of their size, that's significant.
Absolutely.
But for many smaller, more speculative altcoins, particularly those in DeFi and meme coin sectors, the impact was brutal.
Oh, yeah. Carnage in some corners.
We saw some, like BOMA and SEI, experience double-digit nosedives, losing upwards of 10%, 15%, even 20% of their value, just like that, in a blink. And this kind of widespread rapid decline, it isn't just about price numbers on a screen, is it? It has very real, very tangible collateral damage.
Exactly. For individual traders, for the market infrastructure.
Yeah.
Precisely. This substantial and rapid correction, it led to the forced liquidation of over 160,000 over-leveraged trading positions.
Okay, 160,000 traders. Let's break that down. What does over-leveraged long really mean for someone maybe new to this?
Sure. So when you take out a long position, you're basically betting the price of an asset will go up. Pretty simple.
Right. Betting on increase.
To amplify potential gains, traders often use borrowed money. That's the leverage part. You might put down, say, $1,000 of your own money, but control $10,000 worth of Bitcoin, for example.
So bigger potential wins.
But, and this is the crucial part, it comes with magnified risk. If the price move against you, as it did here, Bitcoin, altcoins falling sharply, and it drops enough to wipe out your initial capital, your $1,000, and then some, your position gets automatically closed out by the exchange.
To stop the bleeding, essentially.
Exactly. To prevent further losses for you and the exchange. This forced closure is called liquidation. And it's brutal because it happens automatically and quickly.
And the total value of these liquidations?
It reached a massive $650 million.
$650 million.
And, get this, over $600 million of that total was specifically from those long, the people betting on price increases being wiped out.
So the vast majority were betting the wrong way.
In this instance, yes. And this cascading effect of liquidations, it can actually make a market downturn worse.
How so?
Because these forced sales add further selling pressure. It creates this vicious cycle of fear and downward momentum. More selling pushes prices lower, triggering more liquidations and so on.
That's a huge amount of capital lost by individuals. It really paints a vivid picture of the risk involved.
It certainly does.
But you mentioned earlier that while painful, this event wasn't as painful as some previous market shocks. Can you give us some perspective on that comparison? What does that tell us?
Yeah. Perspective is always crucial, isn't it? Especially in volatile markets. While yesterday's $150 billion dump and the $650 million in liquidations were undoubtedly painful for many, the current landscape is, fortunately perhaps, not as painful as a previous significant event we saw. You might recall the entire market plunge back in April.
Vaguely, yeah. Also related to tariffs.
It also followed an original tariff call by President Trump, yes. At that time, Bitcoin went from six-digit territory all the way down to a 5-month low of under $75,000.
Okay, that was much worse.
Much worse, within just days. And the overall market wiped out nearly $500 billion then.
$500 billion, okay.
So that was truly seismic. While $150 billion yesterday is significant, very impactful, it's important to remember it's not the largest we've seen recently.
So what does that comparison tell us? Are we getting more resilient or just used to it?
Maybe a bit of both.
Yeah.
But seriously, it highlights a consistent vulnerability of digital assets to these major policy shocks. It tells us that while the market is maturing in some ways, it's still highly sensitive to macroeconomic and geopolitical shifts. Perhaps even more so than some traditional asset classes, just because of its inherent volatility and relatively newer institutional liquidity.
Right.
It might also suggest that market participants are learning to react maybe quicker. Or perhaps that some of the really excessive leverage speculation got flushed out in those earlier events, like April's plunge.
Interesting. Well, as we consider how swishly these markets can move and the profound impact these global events can have on, your digital assets, it really brings to mind the importance of being prepared.
Absolutely. Preparedness is key.
And having the right tools for engagement. So if you're not already set up on exchanges, or maybe you're looking for a reliable platform, now might be the time to consider your options.
Good point.
You can actually register today and get a 10% discount on spot and futures commissions on the BingX exchange. And make sure to subscribe to our Telegram channel. We share real-time updates and deeper dives into market movements there.
Definitely useful resources.
All the links for BingX and Telegram are, of course, in the description right below this deep dive.
Okay, so that brings us to a really important question, I think. It extends beyond just the immediate trading implications.
Which is?
Why should someone who might not directly trade digital assets, maybe doesn't even care that much about them, why should they pay attention to global tariff policies?
Yeah, good question. Why should they care?
The answer really lies in the deeply interconnected nature of global finance today. It's increasingly interdependent.
Okay.
These macroeconomic shifts, even ones specifically targeting traditional goods and services, like tariffs, they can ripple through quickly, unexpectedly, to new innovative asset classes like digital currencies.
So it's not just a crypto problem or a trade problem.
Exactly. What we saw yesterday wasn't some isolated internal event within the digital asset space. It was a direct, undeniable consequence of a traditional economic policy decision reverberating across the entire financial ecosystem.
So what does this all mean then for understanding these complex connections? It feels like it's no longer enough to just watch the digital asset charts or follow crypto-specific news anymore.
You've hit the nail on the head.
This event clearly shows you have to keep a broader eye on global economics, on politics.
Exactly. That's the key takeaway for you, the informed learner. In this increasingly intertwined global economy, understanding the impact of seemingly distant policy decisions is absolutely crucial.
Crucial for what, specifically?
Crucial for making sense of market behavior, even in innovative sectors like digital assets. It's about recognizing how global policy, whether it's interest rates, trade tariffs, geopolitical tensions, how it drives sentiment across all markets.
And sentiment drives price.
Sentiment drives value. Not just in stocks, bonds, commodities, but profoundly in digital currencies and tokens, too. These events underscore that the digital asset market isn't an island. It's intricately woven into the broader fabric of global economics and politics.
Can you give an example of that weave?
Sure. Think about large institutional investors. They often allocate capital across diverse asset classes. When macro uncertainty hits, like with these tariffs, they don't just pull money from traditional equities. They de-risk across their entire portfolio.
Oh, Okay.
And that often means withdrawing from more speculative, volatile assets like crypto.
Oh.
So that creates a direct channel for traditional policy decisions to impact digital assets.
I see.
Even something like the strength of the US dollar, which is influenced by these policies, can indirectly affect Bitcoin's price.
Yeah.
A stronger dollar might make dollar-denominated assets, including crypto, less attractive to international investors. Understanding these sort of hidden links, that's what being truly informed means today.
So just to recap then, a single policy decision, a tariff adjustment, focused entirely on traditional goods,
Right.
led to a multi-billion-dollar shift in the digital asset market and impacted tens of thousands of traders directly.
A powerful, immediate reminder.
Yeah, of how interconnected our world has become. And maybe consider this, how events like these underscore the growing maturity, maybe. And paradoxically, the growing interconnectedness of the digital asset space with traditional financial markets, with global politics.
It's a fascinating dynamic.
It really is.
Yeah.
It's a profound reminder that truly being well-informed now means looking far beyond just one specific asset class. You have to understand the broader geopolitical and macroeconomic landscape.
Absolutely.
It means recognizing that the first domino to fall might be, in Washington, D.C. or a global trade negotiation, but the last one to topple could very well be right there in your digital wallet.
Well put.
So if you found this deep dive valuable, and we certainly hope you did,
We hope so.
make sure to subscribe, like, and definitely hit that notification bell so you don't miss our next exploration into the fascinating world of knowledge.